welcome to our very first self-directed IRA and Solo 401k Q&A session of 2025. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Today I have Dmitriy Fomichenko here with me. He will be answering all of the Solo 401k and self-directed IRA questions. Dmitry is the founder and president of Sense Financial Services. He began his career in financial planning and real estate investing in 2000. He owns multiple investment properties in various states and is a licensed California real estate broker. Dmitry holds a designation of Certified IRA Services Professional from the American Bankers Association. And over the years, he's taught hundreds of investment and financial planning seminars and has mentored thousands of investors. Welcome, Dmitry. Thank you for taking the time to answer questions today.
Sure. Natalie, thanks for joining me. And hello, everyone. Happy New Year. And welcome to 2025. Looking forward to another great year serving you guys. And let's jump into the questions.
Yeah, first question here is from Selena. I sold a house I had in the Solo 401k this year. Do I need to file the report this January?
Selena, if you sold investment property in your Solo 401k, you don't need to do any reporting specifically on that because the Solo 401k plan is a tax deferred retirement vehicle. And there is no gains to you personally, and it just selling a stock inside of your IRA or 401k. You can sell this property and just reinvest the proceeds into something else. There is a reporting requirements for the plan, not for the property that you sold specifically, but for the plan itself, 5500 EZ. So be sure to be aware of that and submit those filings as needed, but not for the property itself.
Second question here is from David. He would like clarification on the BOIR, specifically the second injunction that happened on December 26th.
Yeah, so the BOIR stands for Beneficial Owner Information Reporting, and this is a new law that went into effect in January of last year, 2024. And this law essentially requires everyone who owns or control any LLC or a corporation submit the report indicating who the beneficial owner of that entity is. And the purpose of this law is to combat money laundering. You simply report, again, in most cases, that's going to be yourself and maybe your spouse, your partner who's behind that entity. All this information government already has, so it's not really anything new that you'll have to report. So the law went into effect, and then it has been blocked, and then it has been reversed, and then it has been blocked again recently, just days ago. But my recommendation is that you still go ahead and submit. If you do own or control any entity, LLC or corporation, you should submit that reporting, because once that law gets reversed again, which most likely it will, then if you fail to report, you will be subject to severe penalties and up to 2 years of imprisonment. So don't play with this. Go ahead and submit the report. It's pretty straightforward. We can help you submit that reporting. Take this serious and submit the report.
Next question here is from Rich. Can I make a contribution from my Bitcoin profits to my Solo 401k?
Rich, good question. The contributions to Solo 401k can only be made from the earned self-employed income. So if you have a Solo 401k, you have a business or self-employment activity that acts as a sponsor of the 401k, and the income from that business activity or self-employment is what can be used to calculate your contributions to a solo 401k. So if you made profit from Bitcoin or any other investments, you cannot use those profits or gains from those investment activities. Again, it's only business, self-employed business income that can be used to calculate your contributions.
We have a question from John. What is the difference between a solo 401k and a 401k? Can I establish it at a bank of my choice?
Thanks, Jana. Before I jump to your question, just wanted to make a comment that sometimes when I read those questions, they might be a little bit incomplete. I don't have all the information, so I'm doing my best to answer the question based on the way it was posed. But if you want to provide further clarification, perhaps, to your question, or ask follow-up question, or if what we are discussing today prompts another question, any one of you there, just go ahead and type that at the Q&A section of the screen here, and we will get to your questions once we're done with the pre-submitted questions. So now back to John's question, the difference between solo 401k and a 401k. Solo 401k is a 401k, but it's just a simplified version, if you will. Solo means one participant. Sometimes it can be two, so it can be a little bit deceiving. So it's not always one. In most cases, it is one participant, but basically, solo 401k designed for business owners and their spouses. There is no other participants. There is no non-owner participants. So that's the difference. In a 401k, another employer that have employees participating, so it can be owner plus the employees. Solo 401k, it's only the owner and the spouse. So there is no non-owner participants there. So that's really the main difference. Can you establish a solo 401k at a bank? Well, some banks do allow or establishment of the solo 401k, and perhaps can do that. But if you're here on this session, you're probably looking at the self-directed solo 401k plan. So, well, you can establish retirement plan at some banks and other financial institutions, brokerages. It's not going to be self-directed. Your investment choices will be restricted to what that financial institution offers. But with the self-directed solo 401k plan, or self-directed IRA for that matter, you can use your funds to invest into virtually anything. You're not restricted by the plan provider. Our plan does not have any limitations on the investment choices. It's basically only what IRS limits, the prohibited transactions, which are, as far as the investment choices, that's limited to collectibles and life insurance, and any transaction with disqualified person. But again, if you're looking into establishing a self-directed solo 401k plan, we can establish the plan for you. The actual account can be opened at a bank of your choice. Although we do have a preferred banks that we recommend to make the process easier for you, because most banks are not familiar with the concept of self-directed solo 401k. So again, you use us to establish the plan, and then account can be opened at a bank. I hope that helps.
This question is from Amy. If I have an existing solo 401k loan, can I pay off the balance and borrow again soon?
Good question, Amy. So if you have an existing solo 401k loan, you can pay that off at any time. You can continue the loan based on the loan payment schedule, or you can pay off the loan sooner, early. Now, if you do pay it off early, you actually have to wait 12 months before you can borrow the same amount again. So there is a waiting period. Again, depending on the basically, when you're applying for a loan, you have to factor in, when you're calculating how much is available to you, you have to factor in the highest outstanding loan balance in the past 12 months. So that will be the limitation for you. So depending on the total loan amount that you have now, you can, with our plan documents allow up to 3 loans. But again, let's say if you had a loan balance today that is $50,000, which is the maximum, and you pay that off tomorrow, you're going to have to wait a year before you can borrow another $50,000. Here's another example. If you have a loan balance today that is $20,000 and you pay that off tomorrow, you will have to subtract this $20,000 from the maximum of 50, and that will leave you $30,000 that you could potentially borrow tomorrow. Again, hope that makes sense. But if you're considering taking a loan, a new loan or maybe a second loan, you can go to the client portal. You can go to the maintenance section. You can go to the participant loan page and look at the loan application, which has a loan calculator. One of the pages is loan calculator. It's pretty straightforward. You just answer the questions, and then you'll see the maximum loan amount that you can borrow. Do that.
This question is from Glenn. How do you write off an unsecured loan that's non-performing for 2 years?
Glenn, good question. And again, that's the limited information that I have here. So who is the lender? Is it, did you make this loan personally, or did you make this loan from your retirement account? Regardless, first and foremost, never, that's my advice to you as an investor, never do unsecured loan, because that's what happens. That's the risk that you're running. The borrower defaults and you've got nothing, no collateral there. I personally been a private lender for over a decade. I've done several dozen loans, foreclosed on one, have that experience. But when you lending and the loan is secure, you have the collateral. So your principal is secured. You can always recover that. But when it's unsecured, you have that risk. So again, if it's a personal loan, I can't really answer that. That's something that you perhaps need to talk to your CPA. If you made this loan from your retirement account, an IRA, or a 401k, there is no such thing as writing off. It's just a loss. Think of it that you made the investment, you purchased a stock of a company that went under, right? And so your investment is gone. So there is no such thing as writing off. Hope that helps.
Next question is from Jay. How do you catch up on loan repayments?
Yeah, we got several questions about loans today. But if you have outstanding participant loan, you actually have, there's a grace period that is allowed for you to actually catch up on your payments. And the grace period basically is the quarter prior to the quarter that you're in. So right now we're in the Q1 of 2025. The previous quarter will be Q4 of 2024. So if your last payment was in a Q4 of 2024, you can actually catch up on those past due loan payments and make the loan whole. But if you're past the previous quarter, so let's say if the last payment on the loan you made in Q2 of 2024, your loan is now in default, and that will be considered a taxable distribution. So you have to work with your CPA to report that as a taxable event, pay the taxes and pay the penalties on that. But again, if it's in the quarter prior to today's, then you can catch up on those loan repayments.
This question is from Race. Can we invest part of Solo 401k Roth money into Bitcoin?
Yes, you can use your Solo 401k, whether it's pre-tax or Roth, and invest in Bitcoin or any other cryptocurrency. You will need to establish an exchange account with one of the exchanges. We do have an article with some of the details, just some general guidance on how to do that. So if you navigate to the client portal, go to the knowledge base and just search for a keyword cryptocurrency, you will find that article with the guidance in there. The key here is that you cannot combine it with your existing account that you may have at exchange. So it has to be a new account in the name of the 401k. You have to keep everything separated and at arm's length from your personal or your business finances and investments.
The next question is from Niraj. With an income of 80K in my company, what is the best calculation to maximize my Solo 401k?
Niraj, to calculate the amount that you can contribute to your Solo 401k, you need to determine your compensation. So it's not just the income that your company generates, but it's the type of business that you have. Is it a sole proprietorship? Is this an LLC that is taxed pass-through? Or is this a corporation or LLC taxed as a corporation? So different entity types, they have different calculations. That's the number one. And then number two, you have to determine the compensation. So if it is LLC taxed as a pass-through, then you have to determine the profit, not just the income. So you have to subtract all of the expenses from the income, determine that amount, and then subtract half of the self-employment taxes before you can do the calculation. If it is a corporation, C or S Corp, then you are required to pay yourself reasonable salary, and the contribution to the 401k will be based on that salary. The elective deferral contributions will come from the salary. It has to be done through the payroll, and the profit sharing will be based on the salary again. That is the profit sharing contributions made by the company, but it is based on your the amount that salary your company pays you. We do have detailed guidance for that on the client portal and also on our website. The website has a calculator that is very easy to use and very convenient. It will give you exact numbers. But prior to that, I recommend that you go to the client portal, go to the knowledge base, and look for the article called Contribution Basics or Planning for Your Contributions. There are multiple resources, articles, and videos that spell out how to make your contributions. And then use contributions calculator. That will be very, very handy.
Okay, this question is from Lyle. I have not made a contribution for 2024 or converted to Roth. Do I need to fill out a 1099-R?
Well, first of all, the 1099-R is a tax form that is required to be issued and report to the IRS any taxable event or potential taxable event if there's any distribution. So the distribution can be when you move money out of the 401k or when you're doing a Roth conversion. So again, if you haven't done Roth conversion and did not take any distribution, it's not required. If you have not made any contributions are not reported on a 1099-R, so that won't be applicable regardless. but contributions will be reported on your personal or business taxes. So keep that in mind. And again, we do have an article that is pretty handy in the knowledge base. And I believe the title of that is your solo 401k and the personal taxes. So how does it affect your taxes, and what do you have to do? Again, pretty straightforward, not a rocket science there, but you need to understand those basics, and that article will help you.
This question is from Mick. I am paying off my solo 401k loan this month. Is there any paperwork I need to file or complete?
Another long question. Well, Mick, if you're paying off your solo 401k loan, there is no specific paperwork. You already have the paperwork completed when you applied for the loan. So there is a loan application and a loan amortization schedule that is part of your records. And when that loan is paid off, there is nothing in addition to that you need to complete. You have the track record, you have those payments that will be reflected on a statement, a bank statement, and that will be it.
Next question is from David, and he is asking, is the contribution limit for a checkbook Roth IRA the same as a regular Roth IRA?
Good question, David. So is the contribution limit for a Roth IRA comparing to regular IRA? Again, whether it's a Roth or traditional doesn't really make difference. And from the IRS standpoint, there is no such thing as a checkbook IRA. The checkbook IRA is the feature of an IRA that allows you to have checkbook control over your assets, but it's still an IRA. It's either traditional IRA or a Roth IRA. And the limit to a traditional IRA or a Roth IRA is the same. It's $7,000. If you're over age of 50, you have $1,000 catch up, so that makes it $8,000. Again, regardless whether it's an IRA at your local bank, at Fidelity, or any other brokerage, or you have a self-directed IRA with custodian, or you have a checkbook IRA. The limit is all the same, and it's also limit per person. So you might have multiple IRAs, and you may even contribute to multiple IRAs, but the total contribution to all your IRAs cannot exceed that amount. Hope that helps, David.
This question is from Pat. What is the process and how long does it take to roll over my self-directed IRA to my new solo 401k?
Good question, Pat. So if you have a self-directed IRA and you're established a solo 401k, the process to roll over, it's pretty straightforward. Once the solo 401k is in place, you can submit the rollover request to your IRA custodian. If you're moving cash, that's easy. The cash can be moved just by completing the request, submitting that to your custodian, and they will mail the check to you. Once you receive the check, then you can simply deposit that to your new solo 401k bank account, and you don't have to even go anywhere or mail the check anywhere. You can simply use a mobile deposit feature with the bank to make that electronic deposit. If you do have assets in your self-directed IRA, because that's what you mentioned, you have a self-directed IRA. If you have alternative assets, you'll have to retitle them. So that process will take longer. It will be more complex, but if you're in the middle of this process, then work with our team and we'll guide you on what to do. But again, typically it's pretty straightforward process, but depending on what assets there, it might take longer than moving just cash.
Next question here is from Jim. If I use my solo 401k funds for a flip and my profit is 30K, does this mean I can't put it all in there?
Another good question, Jim. So if you made an investment with your solo 401k or your self-directed IRA, all the investment returns must go to the 401k. So it's not a question, can I put it all in? The answer is you must put everything in because your 401k made the investment, and don't be confusing the gains from the investment or the profit or the income that your investment generated with the contributions. Those are two different things. There is a limit on the contributions, how much you can contribute of new money into your retirement account. IRA has a contribution limit, as we just discussed. Solo 401k has a contribution limit. It's based on your net self-employment earnings. But don't be confusing that with the investment returns, profits, or gains that your investment generates. And there is no limit on how much income, profit, or gains your investment can generate. So if you made an investment into something, again, you're using an example here of flipping a property, you made $30,000. Well, if you invested into something and your profit was $1 million, well, guess what? There is no limit on that. Your 401k now grown by $1 million because of this investment that you did. So, and all of that must go back to your 401k because 401k was the owner of that investment, and the investment returns must go back to the 401k. Now, with that in mind, you're talking about flipping a property. So flipping generally is considered an active business. And when you run an active business inside of a tax-deferred retirement plan, there might be consequences, tax consequences, and that is known as a UBIT, which stands for Unrelated Business Income Tax. And this tax was put in place to basically make the level field playing for everybody, because retirement accounts are intended to be invested passively. So if you have other investments in your 401k and you happen to flip one property, and perhaps your intent was to hold on to it, but you had a good offer there that you didn't want to refuse, that's probably going to be okay. But you do want to consult with your CPA to determine if there is a business income. Because if you start, let me give you this example, right? If you're using your 401k to flip properties, and you flipped one property today, and then you flipped another one 3 months later, and then you did two more before the end of the year. So in a matter of over a year, you flipped 4 properties, and those are the only investment activity. Well, looking at this, it's clear that your 401k now running a flipping business. So all of the profit that generated from those flips will be subject to UBIT, Unrelated Business Income Tax. If you do other passive investments, you own rentals, you do maybe some private lending, you maybe own some Bitcoin, and there's just one flip, again, you're probably going to be okay, but be sure to speak with your CPA to determine if there is any UBIT that is due. And if it is, that tax is assessed on your retirement account. So it's not your personal tax, it has nothing to do with your personal tax return. It's completely separate just for that retirement account. So again, consult with your CPA. I hope that helps, Jim.
All right, we're going to move over to answering questions that were submitted during the session. As a reminder, if there are additional questions, please use this time to type them up in the Q&A section. But we have a question here from JC. Do trusts need to file this too? And this was submitted when we were talking about the BOIR.
Yeah, so the BOIR requirement is for entities that is registered with the state. Okay, the trusts are typically not registered with the state, so it will not apply to the trusts. So again, example will be if you have a solo 401k and the trust is the funding mechanism there, it won't apply there. If you have IRA trust, that will not apply either. So it's typically applicable if you own or control LLC or a corporation, which both of those are registered with the state.
Question here from Kim, how to determine FMV for reporting to Solera?
So the FMV stands for fair market value. So, and I probably need a clarification, what asset are you referring to? So if it is a property, if it's real estate, well, that's one thing. There might be other assets that are in your checkbook IRA. So that this a question relates to a checkbook IRA. So if you have a checkbook IRA, whether it's through an LLC or a trust, and you have multiple assets or a single asset perhaps inside of your IRA, LLC or IRA trust, you have to provide the valuation to your IRA custodian. Most likely it's Solera, or perhaps you might be one of the older clients. You might have another custodian there involved, because custodian is required by the IRS to report the value of your IRA to the IRS. If you have a solo 401k, you are the plan administrator, you're the trustee, so there is no middleman there. There is no third party. So that responsibility is on you. But in case of an IRA, that's a responsibility of an IRA custodian. And you must provide the value of the entity that holds those investments. So at the end of the year, you will receive, or you should have received by now, email from your IRA custodian asking you to provide that report. So if you have an IRA, do that. Make sure that you submit that reporting. It's pretty straightforward. As far as how calculate is, you take all of the assets and you add them all up, plus any cash that you may have, just come up with the total and submit that single number to your IRA custodian. The fair market value, back to a question by Kim, if it's a property, you can, there's multiple ways you can get the value of the property. The easiest probably will be just go on Zillow and get the value of the property there. You can also use tax assessed value by the county, although depending on your location, it may not be accurate. You can also ask for a CMA, comparative market analysis, from a local real estate agent. And it doesn't have to be exact because it's not a taxable event. So this is for reporting purposes only. As long as you're close on the value and you have some kind of supporting document for that, again, Zillow will be fine. Then you'll be good to go. If there is a taxable event, such as you're taking a distribution or you're doing a ROT conversion, then you do need accurate valuation. So in this case, if it's a property, you need an appraisal, but not for the reporting requirements. You can just go off of Zillow.
Question here from Scott. How do I value my properties in my solo 401k? For example, I purchase at 50K and seller finance it to a tenant/buyer for 150 for 20 years.
I'm gonna give it my best try here. So Scott, if you purchased the property, let's say earlier in 2024, and then you sold it before the end of the year, well, what is the value of the investment right now? Well, in your case, if you sold the property using seller financing, right, you actually don't own the property. So you're not reporting the property. What do you report? Well, you report a note because your 401k now holds a note on that property. And if you sold it for 150, is the note for 150, or did you receive some down payment and finance perhaps $100,000? So it's you have to report the total assets as of 12/31. So what assets are in your 401k on 12/31? So that could be if you own a property as of December 31st, what's the value of that property? If you own a promissory note, then what is the value of that? So you don't have to value promissory note. It's whatever that is, whatever the outstanding balance is. So that's pretty easy. So hopefully that answers your question, Scott. And again, if you need further clarification, you can reach out to me directly or just type your comment here.
Okay, well, looks like we answered all of the questions today. If there are additional questions about self-directed retirement accounts, please don't hesitate to reach out. We actually do have a question that popped up, so let me go ahead and address this one. So it's from Kim, follow up about FMV. I have a checkbook self-directed IRA, which has cash and private money lending loans, capital investment, receiving monthly dividends, and took a personal distribution.
Well, I don't think I can add much more to what I said. If you have a checkbook IRA, again, what assets did you have as of end of the year in your LLC? I'm assuming that's what you have. Your LLC has assets. You have to take all of those assets, add them all up, and provide that valuation. If you took a personal distribution from an IRA, you took that probably prior to December 31st. Well, that doesn't apply. The distribution will be reported by your custodian. Again, it's very simple. I think some people make it a lot more complex than what it is. All you have to do when trying to determine the value is what assets do you have in your IRA LLC or in your 401k as of 12/31. If it's single asset, the value of that asset plus the cash. If you have multiple assets, you have to add them all up plus any cash you might have in your checking accounts for your retirement account. Add them all up and come up with a single number. That will be it. So again, it's really pretty straightforward calculation.
Okay. No additional questions came through. So again, if there are other questions, reach out to us. We'd be happy to set up a consultation one-on-one so we can discuss your situation. But thank you for joining us. We're looking forward to all of you joining us in future webinars and hope you all have a great day.
It's Natalie for Legion Days, and thank you all for joining. Have a great new year again, and we'll see you soon.